So we've had you before. We had
Yes.
you 6 months ago. It's been a turbulent time. Q4 was particularly turbulent, as we just heard from Neil and Indri. So do you want to explain a little bit about what's been going on and how you sort of viewed it?
You're right, it's been a difficult 6 months. So I'm in the midst of writing the half-year report for Lowland, which is to the end of March. And in that 6-month period, the Lowland NAV, net asset value, would have been down around 10%, versus the market, the benchmark, the FTSE All Share, would have been down about 2%. So it's been really quite a difficult period of underperformance. And I would say there's two key reasons for that. The first is a size element. So we invest in Lowland, we've got about 55% of the portfolio outside of the FTSE 100, so outside of large companies. And those smaller and medium-sized companies have underperformed the benchmark over the past 6 months or so. And I think it's difficult to say in generalities why that is, but I think that's mostly to do with the fact that the smaller and medium-sized companies would be more exposed to domestic UK. And there is a clear, I don't really want to talk about Brexit, but there is a clear domestic political overhang on those smaller and medium-sized companies that are more domestic because of Brexit. And that's causing their valuations just to be pinned down a little bit. So they're at a discount to the broader market, those more domestic companies. So that's one element of the underperformance. The second one would be the sector allocation. So within Lowland, we have around 30% of the portfolio in industrials. And as Neil and Indri were talking about, in the fourth quarter of last year, there were real question marks about global economic growth. And what you saw was those industrials that we hold sold off and were weak performers really quite indiscriminately, without any particular attention being paid to what end markets they're exposed to. So that's where we are, that's the last 6 months. I think if we're looking forward from here, what's really making me and James, who I run the portfolio with, positive is the dividends coming from the portfolio. So Lowland itself would be on an over 4% dividend yield at the moment, which is really quite unusual historically. And I think that over 4% yield is implying a big question mark about the sustainability of that dividend. And we really don't see that running the portfolio. We think that dividend is very well underpinned. So there is a lot of noise, there's Brexit and trade wars and things, but come back to cash, and we feel very comfortable with the dividends being paid, and we think that over 4% yield is a positive sign for the portfolio.
So let's go to the audience. Lowland does not seem to have benefited from recent rises in the market, though. Why is this, and when do you reckon investors will see a recovery in the price?
Yes, so calendar year to date, the NAV, net asset value, would be up just over 5%. That's to the end of March, and we're having quite a good April, so we're up 3 or 4% so far within April. So we are benefiting from the rise in the market, but the question is totally valid. Why haven't we kept up with the FTSE All Share? And there are a few elements to that. The first is that those domestic companies have still been a bit of a drag, so they are still at a valuation discount to the broader market. We also haven't had so what's really performed well this year within the FTSE All Share are some of the consumer staples companies. So for example, tobacco. Lowland has no tobacco at all, and that would have been right on a 1-year period. But calendar year to date, things like BAT, British American Tobacco, have recovered really strongly. We have nothing in the area. I think it's still right to have nothing in the area. Those companies are BAT and Imperial Brands in tobacco are very highly geared. They would look on a low valuation.
So that means they've got a lot of debt, basically.
They've got a lot of debt. They would look like they do have a high dividend yield, and they would look like they would be on a low valuation. But I worry about how much cigarette volumes are declining each year, combined with a high level of debt. So I think it's right that we have nothing in the area, and I'm not tempted to buy them. That would have hurt performance calendar year to date versus the market, because something like BAT, I think, is up almost 30% year to date, which for a big component of the benchmark would be a big relative detractor to something like Lowland, which has nothing in the area. So there's been a few elements. There's been the domestic companies still being a bit of a drag and not catching up in terms of their valuation discount versus the market. And there's been the lack of consumer staples companies within the Lowland portfolio, which has been a mistake calendar year to date.
Yeah, and you're not just going to join in with investments because other people do. It's your own independent valuation.
I think you have to constantly reassess. I look at the tobacco companies all the time and think, is it right that we don't have anything in the area? Because, and I don't like this word underweight, but it is quite a big underweight versus the benchmark to have nothing in tobacco. So you have to keep questioning and checking whether you're right. It's no good just writing something off. So you keep checking, but at the moment I still feel it's right that we have nothing in the area.
Okay, interesting. Would a radical change in government affect your investment strategy?
I presume that's reference to a Corbyn government. So yes, it would. I think that would be really quite relevant for some of our UK companies. We have things like Severn Trent, we have Royal Mail, both of which he's suggested that they may wish to nationalise. So it's definitely something in the back of our minds. I think what you've got to do as a portfolio manager is be aware of that and recognise that in some cases it's reflected in the valuation. So for something like Severn Trent, one of the big water utility companies in the UK, it would be over 2% of the Lowland portfolio. And we have been adding to it recently. And that's because it's at a dividend yield that looks very attractive to us, and it's at a premium to its regulated asset base that it hasn't been at historically, as in it's trading not much above its regulated asset base, and that would be quite a historical anomaly. In other words, people are already worried about a Corbyn government, and it's already to a degree factored into the valuation. And as a value investor, we quite like that. We like when there are question marks about things, because that enables us to get a better dividend yield and to get in at a better valuation. And you just have to be aware that there are these risks and have a diversified portfolio to compensate for that.
Because that's what the market is doing. It's just taking this information and it's saying there's risk.
Of course, so you just have to be aware of it and be aware of it as one of these risk factors that you know of when you're investing. So you just have to go in with your eyes open.
The best income trusts have grown their dividends for over 50 years. How does Lowland stack up to it?
So we made, in hindsight, a bit of a mistake of keeping the dividend flat during the financial crisis. So we've never cut the dividend since the trust was incorporated, which was, I can never remember if it's 1962 or 1963, but a long time ago anyway. So we've never cut the dividend, but we did hold it during the financial crisis. Now, in hindsight, we should have put up the dividend at a 0.1 of a p to say that we've increased it for over 50 years, as some of our peers have done. But we're very proud of the fact that we've never cut the dividend. And we do also have quite a comfortable amount in the revenue reserve. So the idea is use the investment trust structure, make the dividend really predictable for shareholders, and we try and do that by paying a very consistent quarterly dividend.
And then you've got this pot of money in the revenue reserve that if things go really badly, you can hopefully top them up.
For a rainy day, we've got the revenue reserve there, so that we really hope never to have to cut the dividend.
We're seeing a big trend. A lot of investors are moving towards passive funds, index trackers, and the like. So this could be FTSE 100. This could be cryptocurrencies. There's all sorts of them. Do you find this pressure from passive management is putting pressure on you as active managers?
Not really. I think it's a trend that's here to stay, definitely. We need to be aware of it. I think what it means as a portfolio manager is that there's no point running a portfolio that's not differentiated from the benchmark. Lowland is extremely different from the benchmark. It would have sizable sector overweights in things like industrials and financials. It would also be heavily exposed to smaller and medium-sized companies that would be harder to get exposure to via an ETF, an exchange-traded fund. So I think the way we think of Lowland is you could hold it alongside perhaps a FTSE 100 ETF or a FTSE All-Share ETF, and it would be differentiated enough, and it would be different. It would be giving you more income growth, and it would give you exposure to the small and medium-sized company area. So I don't think it's one or the other. Lowland is often held alongside either an index fund or a more core UK income fund as well.